Hey, how's it going, guys? Welcome back to the Module 3 of Options Trading Foundation, the complete options trading course for beginners. Module 3 is all about the spread strategies in options trading. In this video, the sub-module 3.4, which is the last sub-module in the entire Module 3, we will cover another extremely important credit spread strategy, the bear call spread. Alright, let's get started. In the previous tutorial, we talked about the bull-pull spread and mentioned that the best time to use a bull-pull spread is when the market is in a healthy uptrend and entering a short-term consolidation period. But what about those stocks in a downtrend? How to profit from those consolidation phases in the downtrending markets? Then that's exactly where the bear call spread comes into play. The best time to use a bear call spread is when you see a stock is in a downtrend but entering a potential consolidation phase and the price is possibly going to trade in a range with strong support and resistance levels. In general, the stock market only trades 30% of the time and the rest of the 70% of the time are all trading in ranges. And this bear call spread is a perfect strategy to take advantage of those sideways ranging market actions in a downtrend. Of course, when a stock is in a downtrend, the downside pressure over that stock is a lot higher than the upside pressure, meaning the probability of that stock makes further down move will be much higher than it reverses and it goes up. The bear call spread can also take advantage of this potential moderate bearish down move in a stock without overpaying the put option premiums. Same as the rest of the spread strategies, there are two trade legs in a bear call spread. First, you buy one call option with a higher strike price, then you sell one call option on the same stock with a lower strike price. For call options, the lower the strike price is, the higher the premium will be traded in the options market. So, the instant income you will get from your second trade leg by short selling lower strike call option will be more than the cost that you have on your first trade leg. This is exactly how you create this initial credit spread into your account when you put up this trade. Here are the important details to notice. All the options you will be using in the bear call spread are all call options only, no put options involved. The short call is for the purpose of the income generation, while the long call is for the protection. The call option in both trade legs should have exactly the same expiration date, and the number of the call options you buy and sell should be exactly the same. Basically, the main goal of a bear call spread is to let all the call options in both of your trade legs expire worthless and you keep the initial premium income as the profits. Alright, now let's do a case study and see how exactly the bear call spread works with a real trade example. JP Morgan stock is currently traded at $250 per share in October 2020. For the past few months, because of the Federal Reserve's extreme dovish fiscal policies, which hurts the financial stocks a lot, JPM stock has formed a clear downtrend, and now it started entering a consolidation phase. After you did some technical analysis, you believe that JPM stock will be trading in a range over the next 2 months, with the strong resistance level at $260 and the support at $225. On top of that, you also believe that most of the Federal Reserve's dovish reaction have already been fully priced in. There might be a moderate downside move on JPM stock, but you don't see another major crash coming in the near future. So, what is the best strategy to profit from such market conditions? The best way to take advantage of such markets is to use a bear call spread, and this is how it works. First, you buy one JP Morgan December 2020 call option at a $275 strike. The premium of this call option is currently traded at $8.8 per contract. Then simultaneously, you sell one JP Morgan December 2020 call option at a $260 strike, which is traded at a $15.9 per contract. After you complete this bear call spread trade, you will have a net credit of $710. This is the instant income in the form of premium that goes into your account directly after you complete this trade. Your total maximum risk on this trade will be the difference between those two strike prices multiplied by 100 and then minus the net credit. After the calculation, we can get the total risk will be $790. Your maximum potential reward is equal to the initial net credit, which is $710. And finally, the break-even price for this trade will be your lowest strike price plus the net credit divided by 100. And after the calculation, we can get the break-even price will be $267.1. Alright, once we have all these numbers, we can now draw the risk graph for this bear call spread trade. So this is how the P&L line looks like for the bear call spread. First, you have the highest strike at the 275 and the lowest strike at the 260. Then you have the break-even price as $267.1. Remember, the lowest strike price, $260, is where the short-term strong resistance level is. When the stock price stays below your break-even price, your bear call trade will be in the profit zone. And if the stock price can stay below $260 by the expiration date, which is exactly what you expect because the $260 is the strong resistance, then in that case, your trade will end up with the maximum profit of $710. On the other hand, if the stock price goes up and stays above the break-even price, your trade will be in losses. And if the price makes a big move to the upside and close above $275 by the expiration date, your bear call trade will hit the maximum loss, which is $790. So as we can see from this risk graph, the best case scenario for your bear call spread is when the underlying stock price will not break the short-term resistance level, stays below it until the expiration, then all the call options in both of your trade legs will be out of the money on the expiration and go expire worthless. That's exactly what you want, because you can then keep all of your initial credit as your easy maximum profits. In the previous video, when we talked about the bull-put spread, I mentioned that all the credit spreads have low reward to risk ratio, but with extremely high probability or the win rates. And also that the time decay works exactly in your favor. And that applies to all the bear call spread trades as well. Although it may seem like you are risking $790 to gain a potential profit of just $710. But in reality, if your initial technical analysis was done correctly and your trade construction was done properly, the chances of your underlying stock price moves and stays above your break-even price is very low. And also, credit spread trades usually have pretty short expiration periods, so you can move in and out of a trade and generate a small amount of instant income pretty quickly, and those profits do add up after you take several trades. Similar to the bull-put spread, choosing the right strike prices for bear call spread trades also follow these two rules for all the beginners. Rule number 1, your lower strike price should be near or at the resistance price level. This is the price which you believe the underlying stock price will not break in the near future. And then rule number 2 is that your higher strike price should be carefully calculated by your maximum risk per trade. For all the beginner options traders, whenever it comes to those key market resistance levels, the first trade setup they can think of is to buy the put options at exact resistance levels. But the major problem of such trade setup is that those put options at a resistance level will be very expensive. First, it's because they're the in-the-money options with very short expiration time. No matter if it's a call option or put option, in-the-money options are much more expensive than those out-of-the-money options, especially when the time period is short. Second, the implied volatility at the key resistance level will also go up, and that could push the premium even higher. For example, for the JP Morgan December 2020 put option at a $260 strike, the premium is traded at $18.2 per contract. So directly buying put options at a resistance level is a pretty risky trade, and let me show you why. Let's compare the bear call spread trade we just did in a case study with the directly long put trade. Your maximum risk for bear call spread is $790, but for the long put trade, your maximum risk will be $1,820, which is way much higher than your bear call spread trade. Maximum reward for bear call is $710 and unlimited for the long put, but the maximum downside for stock can go to is 0. It doesn't cost anything to take a bear call spread trade because you will create an initial credit into your account once you put that trade. But if you directly buy a put option, you will have to pay $1,820 as soon as you put on that trade. The break-even price of a bear call spread is much higher than directly buying put options because it is a bearish trade setup. You want your break-even price to be as high as possible. The higher your break-even price is, the higher probability your trade will end up with a profit by the expirations. Alright, here's the quick summary of the bear call spread. It works the best when the underlying stock is in a clear downtrend and entering a range consolidation phase with higher volatility. Same as the bull-put spread, the bear call spread is also a credit spread strategy, which means you will have an initial amount of money goes into your account when you put on such trades. Both of your maximum risk and the reward will be limited. The reward to risk ratio will be lower, but the win rate will be very high. There is no initial cost to put on a bear call spread trade. And all of the money put options with less than 60 days are highly preferred for the bear call spread trades. And for the beginner tips, this part is exactly the same as the bull-put spread. So I will not repeat it all over again. You can go back to the sub-module 3.3 for more details of this part if you want. Alright, that will be the end of this module 3.4 on the bear call spread. And that means we have completed the entire module 3 on the option spread strategies. In the coming next 4 tutorial videos, we will move on to the module 4 and share with you guys the top 4 advanced option trading strategies that every beginner should know. If you are new to this channel, my name is Vic. I hope you guys enjoyed the course so far. If you find my contents have been valuable to you, please consider subscribing. Again, thanks so much for watching guys, and I'll see you guys in the next one. Bye for now.